Now, as far as we talk about the F9 paper, which is FM Financial Management. Okay. Okay. Sumbul Fatma, the WhatsApp group link has just been shared by a student. Thank you. Okay, as we talk about F9 Financial Management, okay, we all know that this paper is based on 3 sections. Section A, which has 15 MCQs, Section B, which has 3 MTQs, and Section C, which has 2 long questions. Okay. Now, if you look at the past papers of ACCA, obviously every student, when he prepares from whichever source he prepares, he goes to have a look towards the ACCA past papers. Okay. Now, in the past papers, students suddenly find that in the past papers, 95% times only long questions are published. Okay, so he has a very good he gets a very good practice of the long questions. Okay, but when we talk about MCQs and MTQs, they are rarely published by ACCA. Okay, now obviously ACCA is an organization and it's their policy that what do they want to publish, what they don't want to publish. Okay, so students, when they complete the whole syllabus, they realize in the end that the amount of practice they got as far as long questions was concerned was good, but the amount of practice which they got as far as the MTQs was concerned was really less. Okay, so then they deviate themselves towards the Kaplan kit or PPP kit, find some practice, but eventually when they even practice kit, they don't find too much optimism that their examination MCQs, MTQs are going well. Okay, so considering this particular issue in mind, I started conducting these sessions, this examination session 1 week before the exam, 3 days before the exams. And over the span of time, these have become a very, very integral part of student preparation. Okay. Now, in these sessions, what we do, we specifically target MCQs and MTQs only. We don't target long questions. We solve 5, 10 MCQs, MTQs. Okay. Obviously, if an MCQ solves a WAC, that revises the WAC as well, and as well you get some MCQs. But the questions I discuss with you, okay, obviously, I'm not someone who can forecast the paper, but all these MCQs are gathered from different resources. Okay, so whenever before the exam, I ask students to have this webinar. After this webinar, I will share with you 3 more videos of MCQs. After this webinar, I will share with you 3 more videos of MCQs. Okay. And I strongly request everyone that you are seeing this video. Okay. This is also an MCQ video. And after this class, you have 1 week to the exam. I will share with you in the group. That's why I've made the group 3 more MCQ videos. Okay. I would strongly suggest all of you to watch all these videos, this one, as well as the 3 I'm sharing, because in the past, September attempt that has just gone, June attempt that has just gone, March attempt that has just gone, December 2020 that has just gone when I launched this, every student who has taken these classes, you all are in the group, right? Okay, you all have joined the WhatsApp group. They give the feedback in the group that from these 3-4 videos, they got 2-3 MCQs in the exam, real exam, 4 or 5 MCQs, even some got. Now, if someone who has a tendency to fail at 48, 46, and he gets luckily 2 to 3 MCQs from my videos, that's enough for him to pass. Okay, so this is pure luck, right? Some people say I got 1 MCQ from your videos. Some people say I got 2. Some people say I got 3. And sometimes people say that I got 5 MCQs from your classes. Okay, So this is something of a very important nature, that once you see this class and see 3 more videos, you can have a good grip on MCQs, right? Okay, so the 3 remaining videos I will share after the class. Let's start today's class. We are going to target, and these MCQs which I have selected are based on my research on what topics I guess that are likely to come up in the exam. Okay, so we are targeting a past exam paper question of WAC firstly, and this MCQ is in front of your screen. We will firstly discuss this question. Okay, it helps you recap as well some things. Okay. Let's start. The question states, Tulip Company is a large company with an equity beta of 1.05. Okay, Tulip Company is a large company. It has an equity beta of 1.05. The company plans to expand existing business by acquiring new factory at a cost of 20 billion. So the company plans to expand existing business. Now, you all have studied weighted average cost of capital in your F9 syllabus. You know that in weighted average cost of capital, there are 2 cases. One is expansion and one is diversification. In diversification, you have to do that ungearing, regearing step. But this question, it states the company plans to expand existing business. Okay, it's an expansion case. Okay, not a diversification case. By acquiring new factory at a cost of 20 million, the finance for the expansion will be raised from an issue of 3% loan notes issued at nominal value of 100 per loan note. So finance will be raised from a loan note issue of 3%. It's issued at nominal value of 100. The loan notes will be redeemable after 5 years at nominal value, or convertible at that time into ordinary shares in Tulip with an expected value of 115 per loan note. Okay, so Tulip is a large company. It has an equity beta of 1.05. Company plans to expand business. Okay, and it's an expansion case. Finance will be raised from an issue of 3% loan notes issued at nominal value of 100. The loan notes will be redeemable after 5 years at nominal value, or convertible at that time into ordinary shares, and those shares will have a value of 115. The risk-free rate of return is 2.5%. That's RF. And the equity risk premium is 7.8%. Tulip is seeking additional finance and is considering using Islamic finance in particular, which would require a form which would be similar to equity finance. Okay, so Tulip is seeking additional finance. It's considering using Islamic finance. In particular, would require a form which would be similar to equity financing. Okay, what is the cost of equity of Tulip using the CAPM, capital asset pricing model? Now it's asking cost of equity KE using CAPM. Now, if the question asks you KE using CAPM, we all know that the formula of KE under CAPM is RF plus RM minus RF into beta equity. The question is asking you KE, cost of equity under capital asset pricing model. So KE under CAPM is RF plus RM minus RF beta equity. Okay, so what is the KE under CAPM? It's RF plus RM minus RF beta equity. What is RF? Risk-free rate. 2.5%. I will write 2.5% here. Plus RM minus RF. RM minus RF, this whole bracket is called risk premium. RM minus RF is not the market return. It's RM minus RF. This bracket is called risk premium, which is 7.8% into beta equity. Since it's an expansion case, so expansion case means that it's not ungearing, recurring, just expansion. So equity beta is 1.05. So 7.8% into 1.05 plus 2.5, it's 10.69%. That means 10.7% is the answer. Okay, please note the solution. Please quickly copy the solutions. Okay. Let's move towards the next one. Now, the next requirement is using estimates of 5% and 6%. Using estimates of 5% and 6%. What is the cost of debt of convertible loan notes? Now, using estimates of 5% and 6%, it's asking what is the cost of debt. Now, cost of debt is basically KD. So using 5 and 6, what is the cost of debt? Now we all know that the question is asking cost of debt KD of loan notes. Now to get KD of loan notes, our approach is that to get cost of debt KD, if the loan notes are redeemable or convertible, we use IRR approach, right? If the loan notes are redeemable or convertible, we use IRR approach. Okay. Now through IRR approach, we will see that these loan notes are redeemable or convertible after 5 years. So it's 0, 1 to 4 and 5. 0, 1 to 4 and 5. So what will happen with the loan notes? There are 3 transactions with the loan notes. Firstly, investor comes and buys loan notes. So when the investor will come and buy loan note, he will incur an outflow. At what price company is issuing loan note? 100. So investor has to bear an outflow of 100. Okay. Once he bears an outflow of 100, once he bears an outflow of 100, he gets after tax interest for 5 years. Now there is no tax in this question. So after tax interest or before tax interest is the same. So interest is 3% and 3% of what? Always the par value, and par value is 100. Interest is always paid on par. So 3% of par, the interest is 3 for 5 years. That's an inflow. And then these loan notes will be redeemed or converted. So redeemable after 5 years at nominal value 100 or convertible with a value of 115. Now, when you give investor the choice that redeem at par value of 100 or convert at value of 115, obviously he will select the higher option. So investor will go for 115. That means he will get an inflow in redemption or conversion of 115. These are the 3 transactions which we bear in a loan note in a bond. Investor buys it, he gets an outflow from his pocket. So the outflow from the pocket of the investor is 100 because company is issuing loan note at 100, investor has to bear outflow of 100. Then he gets interest 3% of par, $103 for 5 years, and then redemption or conversion, it's at 115. That's it. We get net cash flows 100, 3, 118. Okay. For IRR, we need 2 NPVs. Okay, so net cash flows has to be multiplied by discount factor to get present value. Now in IRR, you can use any percentages, but the question has specifically said use 5 and 6. So I will firstly use discount factor of 5%. Okay, when I use the discount factor of 5%, you all have the discount factor tables with you, I'm sure. Okay, the factors are for 0, 1, for 1 to 4 annuities 4.329. And it's 0.784 for 5. Okay, so the discount factor, you can use any, but the question is specifically said 5 and 6. So I will use 5%. Year 0 factor is 1. For 1 to 4, the annuity factor is 4.329. And for year 5, the discount factor at 5% is 0.784. Net cash flows into discount factor is present value 100 into 100 negative, 3 into 4.329. It's 12.987 positive, and 118 into 0.784. It's 92.5 positive. And when you net them all, you get NPV. 92.5 plus 12.987 minus 100. 5.5 positive. Now you have got the positive NPV. For IRR, you need one more NPV, that's negative. For negative, you need to increase the discount rate. The net discount rate, they are saying it's 6%. Now we look at the factors at 6%. Sorry, it's 3.5460, the factor I mistakenly wrote wrong. It's 3.13 positive. Okay. Now, you have the positive NPV. For negative, you need to increase the rate. Let's find the factors at 6%. Now, at 6%, the factors here, 0 is 1. Okay. For year 5, it's 0.747. And can anybody just message me the factor for 1 to 4 at 6%? $3.465. Now you have increased the factor at 6%. Net cash flows need to be multiplied now with 6% to get present value. 100 into 1 is 100 negative. 3 into 3.465. It's 10.4 positive. And 118 into 0.747. It's 88.15 positive. And we net them all, we get another NPV. 1.45 negative. Now we have the positive negative NPVs, we can just place it in IRR formula. Small a, the rate of positive NPV 5%, plus capital A positive NPV 3.13, positive 3.13 minus negative NPV 1.45, into small b, rate of negative 6% minus rate of positive 5%. Mathematically, we will first divide. Then multiply and then add. 5.7% is the answer. That's IRR cost of debt. Okay. So obviously you might have studied WACC and you have witnessed it that whenever in WACC we need to find cost of debt. For cost of debt of redeemable or convertible, we use IRR. 3 transactions, investor goes and buys, outflow from his pocket. So they are issuing at 100 per loan note. That means investor will go and buy for 100, outflow is 100. He gets interest of 3% at par 100 inflow. And then redemption is at nominal value, conversion is at 115. He will opt for the higher option, conversion, his inflow would be 115. 3 transactions, you get net cash flow. Multiply with any 2 discount factors to get present value and then put it in IRR. It has specifically mentioned 5% and 6%. So we use 5 and 6 and got IRR. Okay. And yes, I am just solving it on the screen. Obviously, you have the spreadsheet there. You can directly use it on the spreadsheet. Okay. There is one question from a student which states that 115 is not market value. It's Mohammed Khan. So we never said that 115 is market value. We said how much inflow he will get. So the loans will be redeemable after 5 years at nominal value 100 or at a value of 115. Investor will opt for 115. We will get 115. We never said it's market value. Okay. So please copy it. Zishan, the formula you are setting, that's for irredeemable loan note. This one is not irredeemable, so you cannot use that formula. Zishan, I am very much surprised that you are stating that he asked for irredeemable, and I am not able to find anywhere that where he's asking for irredeemable. If we can see the requirement, he's asking what is the cost of debt of convertible loan notes. And if even you read irredeemable, I don't think in the question anywhere it's mentioned that the debt is irredeemable. It's clearly mentioned it's redeemable or convertible after 5 years. So which question are you referring? Are you on the same question which we are doing here? Yes, Ijaz, you are right. Oh, I'm sorry. I didn't see that question. Okay. Now, obviously, any MTQ is based on a mixture of computation and theory questions. Okay. So now the remaining questions are theoretical in nature. In relation to the dividend growth model, Amrita, I will get back to you on this. In relation to the dividend growth model, which of the following statement is correct? Now, dividend valuation model, it's DVM. K is equals to D1 over P naught plus G. In relation to DVM, which of the following statements is correct? The model assumes that all shareholders of Tulip have the same required rate of return. The model assumes a constant share price, constant dividend growth. Okay. The model assumes that capital markets are semi-strong from efficient. The model assumes that Tulip's interim dividend is equal to final dividend. Now, obviously, if you have studied the dividend valuation model, D1 over P naught plus G, okay. This model computes 1K. That's cost of equity. That is basically return paid to shareholders. Now through DVM, we just find 1KE. And when we find 1KE means, when we find 1KE, it means there is just 1KE and all shareholders will get the same KE. You know, DVM doesn't calculate multiple Ks. It's just calculate 1K. If it's 10%, everyone will get 10%. So correct answer is A. This model assumes that all shareholders have same K. Required rate of return means K. B is wrong. The model assumes a constant share price and constant dividend growth. It does assume constant dividend growth, but it doesn't believe that share price is constant. So B is wrong. Model assumes that capital markets are semi-strong form. This model doesn't talk about capital markets. The model assumes interim dividend is equal to final dividend. It doesn't talk about any interim dividend. Okay, so correct answer of this is A. Interim dividend is the dividend paid in between the year. Okay, fourth, which of the following statements about equity finance is correct? Statement about equity finance is correct. Equity finance reserves represent cash which is available to a company to invest. Additional equity finance can be raised by right issue and bonus issue. Retained earnings are a source of equity finance. Equity finance includes both ordinary shares and preference shares. Okay, the correct answer of this is C. Retained earnings are a source of equity finance. They come in equity. Why the others are wrong? Equity finance include both ordinary shares and preference shares. No, equity finance only includes ordinary shares because preference shares are not included in equity. Sometimes they're included in debt as well. Okay. Additional equity finance can be raised by right issue, correct, and bonus issue. You cannot raise finance via bonus issue. You don't get anything in bonus issue. So this is wrong. Equity finance reserves represent cash. Reserves can be in non-cash form as well. Okay. So retained earnings is equity. That's the correct answer. Okay, so any questions with respect to 18, 19, please ask. Why did I set the other three options of 19 wrong? Equity finance includes ordinary shares and preference shares. They don't necessarily include preference shares. Sometimes preference shares are treated as debt. Additional equity finance can be raised by right issue. Bonus issue, you do not get any finance, and equity finance reserves present cash. Reserves are not always in cash form. Yes, preference shares, there is a complete topic in social law finance that in some cases, preference shares are treated as equity when they are irredeemable. And if preference shares are redeemable, they are treated as debt. You can refer to the sources of finance. Okay, now to answer the MCQ number 20 regarding Tulip's interest in Islamic finance, which of the following statements are correct? Murabba would be used to meet Tulip's financing needs. Mudarba involves an investing partner and a managing or working partner. Okay, now for this, you need to have a sound understanding of what Murabba is and what Mudarba is. Okay, now there are 5 Islamic finance instruments in your syllabus: Murabba, Ijara, Mudarba, Musharaka, okay. So regarding Tulip's interest in Islamic finance, which of the following statement is correct? Murabba could be used to meet Tulip's financing needs. Mudarba involves investing partner, managing partner. You need to have a sound understanding of all these. There are 5 Islamic finance instruments: Murabba, Ijara, Mudarba, Musharaka, Sukuk. Murabba is trade credit, usually used for purchase of raw material. Muraba is trade credit, used for purchase of raw materials. Now, if you go in this MTQ, it's written Tulip is seeking additional finance and is considering Islamic finance, and in particular would like a form which would be similar to equity financing. It likes a form which is similar to equity. It likes a form which is similar to equity. Now, Muraba could be used to meet up Tulip's financing needs. It's written above. Tulip wants something similar to equity. So is Muraba trade credit, obtaining goods on credit, obtaining goods on credit, purchase of raw material? Is it similar to equity? Not at all. Purchase of goods on credit is never same as equity. Tulip wants equity, similar to equity something. Muraba is not equity. It's just purchase of goods, raw material on credit. So is Muraba can be used to meet Tulip's financing needs? No. Tulip doesn't want his financing needs similar to trade credit. If he wants something similar to trade credit, then Muraba. If he wants something like equity, so Muraba is never equity. Okay, so option 1 is wrong. Mudarba involves an investing partner and managing and working partner. If you have understood Islamic finance principles correctly, let me tell you Mudarba. Mudarba is an instrument where one party invests his money and the other just invests his time. He's a working partner. He doesn't invest anything. Profits are shared in agreed ratio. Okay. This also happens in Musharka, but in Musharka, both parties invest and both parties work. In Musharka, both parties invest and both parties work. But in Mudarba, only one party invests and the other just invests his time, works. And profits are then shared in agreed ratio. One is investing money, the other is investing his time. So Mudarba involves an investing partner, one who invests money, and working partner, one who invests his work time. This is correct. So the correct answer would be 2 only. Again, there are many students stating that all 5 should be explained. This is not an explanation class. However, if you are weak in this area or any area, after the class, you can talk to me. We can arrange some stuff for you regarding these 5 principles. But obviously, in between the class, I have to solve questions. I cannot explain all 5 principles. Apologies, but after class, we can help you. Don't worry. I don't think I remember any article, but I can send you all those who have problem in these 5 instruments, my lecture in which I have explained all these 5 issues. Okay. Janzab, we are talking about Mudarba, Musharka, Ijara, Sukuk. Okay, next question is this MTQ Peony company. Start reading this question, then I will read and explain it to you. 2 minutes, just read it on your own. We cannot tell anything about any topic that what is the worth, like this MTQ you are doing, that's from interest rate. So risk management MTQ is definitely going to come either from currency or interest rate. You have to do it. Okay, so the following information relates to questions 26 to 30. Peony's finance director is concerned about the effect of future interest rates on the company and has been looking at the yield curve. Yield curve is just a graph of interest rates. Yield curve is just a graph of interest rates. It tells whether interest rates are curve upwards, downwards, etc. Peony, whose domestic currency is the dollar, plans to take out a 100 million loan in 3 months' time for a period of 9 months. The company is concerned interest rates might rise before the loan is taken out, and the bank has offered a 3v12 forward rate agreement FRA at 7.10-6.85. Now, if you need loan in 3 months for 9 months, obviously the relevant FRA which you should book is 3-12. 7.10-6.85. The lower rate is always the deposit rate, and the higher rate is always the borrowing rate. Okay, so since you are taking out a loan, so the borrowing rate has to be used 7.10%. Okay, because if you plan to take out loan in 3 months for 9 months, it's 3-12. 2 rates of FRA. One is the forward trade agreement rate, like in currency. When 2 rates are given, we say one is buying rate, one is selling rate. Similarly in FRA, one is borrowing rate, one is deposit rate. Okay, lower is deposit. If you are depositing, you take the lower rate. Since you are taking out a loan borrowing, you use the borrowing rate 7.1. The loan will be converted into pesos, invested in a 9-month project, which is expected to generate income of 580 million pesos, with 200 million pesos being paid in 6 months' time and 380 million pesos being paid in 12 months' time. The current spot rate is 5 pesos per dollar. Your domestic currency is dollar. The rate is 5 peso per dollar. Dollar is coming in denominator. It's indirect quote. Okay. So loan will be converted into pesos, invested in 9-month project. It will generate income of 580 million pesos, 200 million pesos in 6 months' time, 380 million in 12 months' time, and spot rate is given. It's indirect quote. Short-term interest rates, dollar rate, pesos rate is given. As a result of general uncertainty over interest rates, Peony is considering a variety of ways in which to manage interest rate risk, including the use of derivatives. You know the interest rate derivatives if you have studied this topic, the futures, options, and swaps. Okay. In relation to the yield curve, which of the following statements is correct? Okay. Expectation theory suggests that deferred consumption requires increased compensation as maturity increases. Now, deferred consumption requires increased compensation. You have to pay more as maturity increases, as time increases. This is stated by liquidity preference theory. You must compensate investors for more time period. This is not stated by expectation theory. This is stated by liquidity preference theory. So this statement is wrong. An inverted yield curve can be caused by government action to increase its long-term borrowing. So government action never results in inverted yield curve. Wrong. A kink, discontinuity in normal yield curve, can be due to different yields in different market segments. Okay. Basis risk can cause the corporate yield curve to rise more steeply than government yield curve. Basis risk doesn't result in any yield curve rising more steeply. So the correct answer of this is C. A discontinuity in normal yield curve, the normal interest rate, can be due to differing yields in different market segments. You know, every segment has different rate. So if there is any discontinuity in interest rates, that may be due to different segments. That is also stated by market segmentation theory. If anyone of you is not getting this point clearly, they must refer to the three theories of interest rates. One is the liquidity preference theory, one is the expectation theory, and one is the market segmentation theory. So you will find this part C in market segmentation theory. Okay. Okay. This one is a very interesting question. Now, the question is, what is the difference between forward exchange contract and forward rate agreement? This is asked by a student. What is the difference between forward exchange contract and forward rate agreement? In forward exchange contract, this is used for currency risk management. We fix currency rates for the future. Whereas in forward rate agreement, that's for interest rate risk. We fix interest rates for the future. Okay. Now, question 27. If the interest rate on loan is 6.5% when it is taken out, what is the nature of the compensatory payment under the forward rate agreement? Now, this is a working which is taught in forward rate agreement, that if the interest rate on loan is 6.5%, what is the nature of the compensatory payment under forward rate agreement? Okay. Now, under forward rate agreement, company plans 100 million loan for 9 months at 7.1%, right? You can see the forward rate agreement details in the question, that plans to take out 100 million loan in 3 months for a period of 9 months. Loan is required for 9 months. And the FRA rate is 7.1, 6.85, borrowing rate is higher, 7.1. So under FRA, the company plans 100 million loan for 9 months at 7.1%. That means it must pay interest of 100 million loan. How much interest it has to pay in forward rate agreement? 7.1% for 9 months. If you just multiply by 7.1%, that's for whole year, but you need it for 9 months. So if you plan an FRA, you must take 100 million loan. Now FRA rate is 7.1%. $100 million on 7.1%. It's 5.325 million. 53,25,000. This is the interest which is locked, because FRA means forward rate agreement. You have made an agreement at 7.1% for 9 months, 100 million. Your interest is locked at 53,25,000. If the interest rate known as 6.5%, now, if interest is 6.5%, the real interest cost is 100 million, 6.5% for 9 months. $48,75,000. Now, this is something interesting, that interest rate on the loan is 6.5% when you take it out. So real interest cost will be 100 million. You have to pay 6.5% for 9 months, 48.75. But in FRA, you made a forward rate agreement. You locked it at 7.1%, 53.25. That means you are making a loss of 450,000, and loss of 450,000 means that Peony has to pay bank 450,000. What is the concept behind this loss? That the real interest rate in the market was 6.5%. So the real interest cost was supposed to be 48.75, but you made an FRA and locked it at 7.1%. So you have to pay 53.25. So due to FRA, you have to pay extra to the bank. Real interest cost was 48.75. You had to pay 43.25. So extra loss of 450,000 that you have to pay to the bank. The correct answer of this is also C. Yes, Ahmed, that's what happens in FRA. If there is a gain, then bank will pay you. Okay. Third question. Using exchange rates based on interest rate parity, what is the dollar income received from the project? Now, the question states, using exchange rates based on interest rate parity, what is the dollar income received from the project? So, what is the dollar income received from the project? Okay. 200 million pesos in 6-month time and 380 million pesos in 12-month time. This is the income. 200 million 6 months, 380 million 12 months. Okay. Spot rate currently is 5 pesos per dollar. So 5 pesos per dollar. What will be after 6 months? What will be after 1 year? You can use the interest rate parity theory. Okay. For 12-month rate, you take the spot rate, 5 pesos per dollar to parity, 1 plus interest rate of the numerator currency. Numerator currency is 10% per year. 1 plus denominator currency, that's 6.5%. So the rate after 12 months will be 5.164. Okay, and for 6 months rate, 5 into 1 plus pesos rate numerator over denominator dollar rate. But since you need 6 months rate, so the rates will be 6 months, 10% per year for 6 months, 5%. It's 6.5% per year for 6 months. It's 3.25%. This you have studied in interest rate parity theory. 5 into 1 plus 5% over 1 plus 3.25%. 5.084. So this 5.084 is the 6-month rate. 200 million pesos are being received in 6 months. How much will be dollar? Convert it into dollar. Multiply, divide. It's indirect code, divide. 5.084. You get $39.3 million. Okay. And 380 million pesos after 12 months. Convert it into dollars. Divide, indirect code. How much rate after 12 months? 5.164. $73.58 million. So $39.3 million for 6 months and 73.58 million for 12 months. You add both 39.3 plus 73.58. You get 112.8. This is the dollar income. 112.8. So the correct answer is going to be 112.9, option D. You simply had to convert it into dollar, the pesos into dollar, but you should have the rate of this 6 months and 12 months. So through parity theories, you have generated that rate. Okay. It's just asking dollar income. So income is received in pesos. 200 million 6 months, 380 million 12 months. So you have to convert it into dollars. You need 6 month and 12-month rate. You got it through parity theories. Okay. Okay, in respect of CUNY managing its interest rate risk, which of the following statements are correct? Smoothing is an interest rate risk hedging technique which involves maintaining a balance between fixed rate and floating rate. That's what smoothing is as per the textbook. It maintains a balance between fixed and floating rate. Asset and liability management can hedge interest rate risk by matching the maturity of assets and liabilities. So matching is a technique which matches the maturity of assets and liabilities. That also written in the book. So in the book, this definition of smoothing and definition of matching is written. That's same as mentioned here. So both statements are correct. That smoothing maintains fixed and floating rate, and matching maintains maturity of assets and liabilities. And lastly, the correct answer of 30 is B. I'm not explaining it at the moment because the other 3 videos which I will be sharing with you, that will explain you this particular option as well, because this type of MCQ is there in that as well. So what we are going to do is that we are going to end this session for today. You have any questions, you can ask me later on the WhatsApp group. Okay, and I will be sharing 3 videos there of MCQs. Make sure you do them before going to the exam. Give the feedback after the exam that you got MCQs from these sessions. Okay, take care. Bye bye. I've shared the link once again. Please join whoever wasn't there.